Welcome back to the WTV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads. Right. Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern. Right. You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information. Right. So, for an example, if I'm in a losing trade, and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case. Right. It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right. I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks that I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to? Or?
Yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13, and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good. Right. And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. My reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you shut off?
Yes, by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
For whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel? Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's just
it's a random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly, okay? Because the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in the machine.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? And then what we do is we wait for a pattern to show up. And if the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. First. The pattern shows up first, okay? Then what we have to do is put up our money, meaning how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. Right. How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it. But they haven't really accepted the risk.
Right. We see that every day. Every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which
is
another problem I want to say.
Oh, yeah. But see, the thing is, it's like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong, and so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
And how does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise they can do?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just like anything else in our lives. When we realize that there's a particular goal that we have, and and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone, or how to think like a professional trader, or some other methodology that people are more comfortable with, or whatever. The point is that if someone really really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay? And that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
What's that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate that potential is by understanding that trading is not about being right or wrong. It's a probability game.
Right.
If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do
evolve. You got an hour and a half, by the way. Keep going. We do?
Oh, okay. Yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities, so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right. On. And that's all it is. When you put on a trade and it doesn't work, all it really means is this: is that some other traders didn't come into the market that had the same belief that you had, or the same conviction that you had about this market doing whatever it is that you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? Someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter, okay?
Exactly.
They find themselves doing things that, what am I doing this for, And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade-by-trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology, at the very most fundamental level, what this is telling me,
right,
is that
fresh cross.
There's a higher there's a high, or let's say, the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now, they're either going to come or they're not. And so, as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out. It's not worth the cost of finding out. That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DVD?
Yeah, absolutely, but not like very specific. Not the kind of specifics that like if you're in a half an hour time frame, how much.
Well, that's the trader's decision.
Yeah.
But the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to their risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
yeah. In other words, so that they can from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely.
For the traders?
Yeah, absolutely. I mean, and that's what I suggest to people, all the time. Especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and they'd get into a situation where they're on a pretty good losing streak, and often it required that they actually go back to a risk level that they hadn't. Meaning that if they were trading 10,000 or 100,000 shares, or willing to take $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that I mean, look at it this way: paper trading. Okay, a lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology. But more so, it is a graphic representation of the mental skills that you don't have. That's
an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills?
Look at your paper trading.
Look at your paper trading in relationship to your real trading. Now, if there's, and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss.
Right.
Because the way our minds think, in other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendencies to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares, and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. That's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at WiseFest and earlier we talked about some events of pain in your life. And a lot of our traders right now are feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there, does a person have to experience this, a total drawdown on their account, a total loss in their account, where their account's almost wiped out or is totally wiped out, for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication, actually? And I'm not trying to be rhetorical here. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You're in pain right now, are you, Jared?
What's that? Yeah. I'm good. I've been out of the market all week.
I'm just kidding. Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring
Well,
to?
explain
Like,
the gutter principle.
The gutter principle, in other words, how much in the gutter do you have to be before you're willing to say, I'll do anything? Mm-hmm. As a matter of fact, this kind of brings something up. Is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine-tuning. Okay, they wanted creative ways of fine-tuning themselves so that they could actually increase the amount of money that they make over a year or whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated, they're so frustrated because of the potential that it's so obvious what the potential is, and yet there seems to be these invisible barriers that keep them from getting into that potential. That they come to me saying, "I'll do anything." And that's, now everyone has different tolerances of pain before they get to the point where they say, "I'll do anything," and mean it, and be sincere,
and mean it. Well,
that's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up this show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders or any final thoughts, maybe a mantra, something?
No, just basically just to kind of sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profits. But I'm saying the pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the objective part about trading.
Because there's no way you can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
okay.
So we've got plenty more time to go. One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10. Mm-hmm. How do you define edge as a closing thought?
Just simply, an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, like for example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back in a couple minutes. Guys, It is time for a break. We want you to get your questions in for Mark. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can send us an email to trader@wisetradetv.com. When we come back, we will answer your questions and talk more about psychology in today's markets. We'll see you back here in 5 minutes.